Imperial Brands is a major British tobacco company and the fourth largest international cigarette manufacturer in the world. The company's portfolio includes well-known combustible tobacco products such as Davidoff, West, Golden Virginia, and Drum, as well as fine-cut tobacco and rolling papers. In recent years, Imperial has expanded into next-generation products, including blue e-cigarettes, Pulse heated tobacco systems, and nicotine pouches like Zone X. Compared to larger peers like Philip Morris and British American Tobacco, Imperial operates at a smaller global scale and has a more selective approach to alternative nicotine products. While PM leads in smoke-free products with IQOS, and BAT holds strong positions in vaping and heated tobacco, Imperial's NGP portfolio remains emerging. Imperial is also distinct for its lower pricing and lower profit margins compared to PM, BAT, and Altria, focusing on the value segment in cigarettes while selectively investing in next-generation products. Against Altria, Imperial benefits from wider international diversification, though both companies face challenges in adapting to shifting regulatory environments and declining traditional cigarette demand. Overall, Imperial Brands combines a strong legacy combustible business with selective investment in next-generation products, offering a unique position within the global tobacco sector. Now let's look at the key risks facing Imperial Brands. The most significant risk is regulatory and taxation pressure, as governments continue to raise excise taxes, restrict advertising, and impose potential flavor bans on both cigarettes and next-generation products. Another major risk is the slow adoption of next-generation products. Imperial's portfolio of vaping, heated tobacco, and nicotine pouches is smaller than Philip Morris's IQOS or BAT's Vuse/Glow, which could slow long-term revenue transformation. Competitive pressure is also high, as Imperial competes with much larger peers across both traditional and reduced-risk categories. Its lower pricing and margins leave less room for strategic error. Additional risks include currency and emerging market exposure, as the company operates in around 120 countries, ESG and investor perception, given the smaller profile in next-gen products, and debt and capital allocation, where careful management is required to balance dividends and investment in growth. Now let's review the major mistakes Imperial Brands has made over the past 5 to 10 years. One of the biggest issues was the slow rollout of next-generation products. Imperial was late to market with e-cigarettes, heated tobacco, and nicotine pouches compared to Philip Morris and BAT, missing an early leadership opportunity in this fast-growing segment. Another significant mistake is the over-reliance on lower-margin cigarettes, especially in the value segment, which leaves less room for investment in innovation and NGP expansion. Capital allocation inefficiencies have also been a challenge. High dividend payouts during a period of slower NGP growth limited resources available for strategic investments and deleveraging. Imperial has also faced regulatory missteps, being slow to adapt to flavor bans and e-cigarette restrictions in certain markets, which slowed product adoption and revenue growth. Finally, brand positioning and market perception remain weaker than larger peers. The company receives less media and institutional attention, which contributes to lower valuation multiples despite solid cash flow. These missteps explain why Imperial Brands lags larger competitors in both reduced-risk product adoption and investor sentiment. Now let's look at the key opportunities for Imperial Brands in 2026 and beyond. The most important opportunity lies in the growth of next-generation products, including vaping, heated tobacco, and nicotine pouches. These segments are growing rapidly, and wider adoption could increase both revenue and margins. Geographic expansion is another key avenue. While Imperial already operates in around 120 countries, there is potential to further expand NGP adoption in Europe, Latin America, and Asia. Operational efficiency and margin improvement is also an opportunity. As NGP volumes scale and manufacturing is optimized, profitability can improve, potentially approaching peer levels. The company's high dividend yield continues to attract income-focused investors while next-generation products mature. Finally, strategic partnerships and selective M&A could accelerate growth and enhance the global footprint of Imperial's NGP portfolio. Overall, Imperial Brands has several levers for growth, but execution in next-generation products and geographic expansion will be key to unlocking long-term value. Now let's review Imperial Brands' key financial metrics. Over the last 10 years, the stock has delivered a 10-year annualized return of 5.7%, including dividends. The P/E ratio is 12.1, indicating a relatively low valuation compared to larger peers, while the beta of 0.15 shows low volatility, making Imperial a defensive investment. From a valuation and leverage perspective, EV to EBITDA is 8, and net debt to EBITDA is 2.1, demonstrating manageable debt levels. Return on invested capital is strong at 16.49%, showing the company generates good returns on its investments. Profitability metrics show a net income margin of 10.9% and a gross margin of 36.9%, lower than competitors like PM or BAT, reflecting Imperial's focus on lower-priced, value segment products. The price-to-free cash flow of 7 highlights the stock's attractive cash generation relative to its market value. Overall, these metrics illustrate a company with strong cash generation, defensive characteristics, and attractive valuation, albeit with lower margins than larger global peers. Finally, let's look at Imperial Brands' dividend profile. The stock offers a dividend yield of 5.3%, with a payout ratio of 75.5%, making the dividend sustainable while leaving room for future growth. From a valuation perspective, Imperial Brands is the cheapest among the 4 major tobacco companies, Philip Morris, British American Tobacco, and Altria, based on metrics like PE and EV/EBITDA. This makes it particularly attractive for investors seeking both income and value. Overall, Imperial combines stable cash flow, low volatility, an attractive dividend, and growth potential in next-generation products, positioning it as a compelling investment in the tobacco sector today. If you found this analysis useful, don't forget to like the video and subscribe to the channel. Your support helps grow this investing channel. Thank you for watching and see you in the next video.